Here's something that sounds backwards, but it's the law. You can have $12,000 of your own money, money you earned, money you already paid taxes on, completely clean. And you can still commit a federal crime just by the way you put it in the bank. Not by hiding it, not by lying, just by being a little too clever about it. And thousands of honest seniors stumble into this trap every year, thinking they're being careful when they're actually breaking the law. I'm June. For more than 20 years, I've helped American retirees protect their money and their benefits. And today, I'm going to clear up one of the biggest, scariest myths floating around out there. The idea that the IRS is secretly watching your bank account and flagging your every move. In the next half hour, I'm going to show you what the government actually sees, what it does not see, the one cash mistake that can genuinely get an honest person in trouble, and the 3 simple steps that keep you completely safe. Stay with me all the way through, because the most important part comes near the end, in step 3. It's the one mistake that even careful, rule-following seniors make all the time, and it's the only thing in this whole video that can actually cost you money or worse. Let me start by taking a weight off your shoulders, because I want you to hear this clearly, sitting right there at your kitchen table. The IRS is not watching your bank account. It does not see your deposits. It does not see your withdrawals. It does not get a daily report of your balance. There is no agent somewhere looking at the fact that you took out $400 on Tuesday. That whole idea, the idea that there's a list of bank moves the IRS is flagging on seniors, that is a myth. It spreads online because fear gets clicks. But it is not true, and I want you to stop carrying that worry. Now let me tell you about Margaret, because her story is the one I see most often. Margaret is 68. She lives outside Tucson, Arizona. She's a careful woman, always has been. She raised 3 kids on a tight budget, and she's never owed anybody a dime she didn't pay back. Last spring, she sold her late husband's pickup truck to a neighbor for $12,000 cash. Good, honest money, her money. And here's where it went sideways. Margaret had heard somewhere, a friend, a video, who knows, that if you deposit more than $10,000 in cash, the bank reports you to the IRS. That scared her. She didn't want any trouble, so she thought she was being smart. On Monday, she deposited $6,000. On Wednesday, she went back and deposited the other $6,000. In her mind, she was just staying under the line and avoiding a headache. What Margaret did not know is that breaking up a deposit on purpose, specifically to stay under that $10,000 line, that has a name, it's called structuring. And structuring is a federal crime, all by itself. Even though every single dollar was legal, even though she did nothing else wrong, the very thing she did to avoid trouble was the only thing in this whole story that could actually get her into trouble. And the most painful part? If Margaret had just walked in once and deposited the full $12,000, she would have done absolutely nothing wrong. Nothing. The bank would have filed a routine form, the way it does millions of times a year, and that would have been the end of it. That's the trap. Honest people walk right into it trying to be careful. So let's make sure you never do. Here's what the law actually says, in plain English. Under a law called the Bank Secrecy Act, when you move more than $10,000 in physical cash in a single day, the bank, not you, the bank, automatically files a routine report called a currency transaction report. The Treasury Department's Financial Crimes Unit, called FinCEN, handles these. And separately, if a business takes in more than $10,000 in cash, that business files something called IRS Form 8300 within 15 days. In plain English, that means this. If you deposit or withdraw more than $10,000 in cash, a piece of paperwork gets filed in the background. That's it. It is not an accusation. It is not an audit. It is not a red flag against your name. It happens millions of times a year to completely ordinary people selling a car, paying for a roof, or moving money around for a family event. So what should you do because of this fact? Nothing, except stop being afraid of it. A big, honest cash deposit is completely legal. Now here's the part that most people, including a lot of financial advisors, get completely wrong. It is not the big deposit that's dangerous. It's the act of trying to dodge it. The IRS puts it about as plainly as it can. Structuring, that's deliberately breaking your cash into smaller pieces to stay under the $10,000 line, is illegal regardless of whether the money came from a legal or illegal source. Read that again. It does not matter that your money is clean. It does not matter that it's yours. If you split it up on purpose to avoid the paperwork, you've potentially broken the law. So picture it side by side. The retiree who walks in and deposits $12,000 at once has done nothing wrong ever. The retiree who deposits $6,000 on Monday and $6,000 on Wednesday to dodge the report has potentially committed a federal crime. The simple, honest move is the safe one. The clever workaround is the actual trap. So what should you do? Never, ever split up a deposit to stay under the limit. If you have the cash, deposit it. Honest and simple wins every time. Now let's talk about what the IRS actually does pay attention to, because this is the real story, and it has nothing to do with spying on your bank. Here's what the IRS actually does. When you file your tax return, the IRS already has copies of your W-2s and your 1099s, including the 1099 that reports money you took out of a retirement account like an IRA or a pension. The IRS runs your return through a computer that simply checks, does the income you reported match the forms we already have? In plain English, that means the IRS isn't watching your bank. It's matching your tax return against paperwork it already received. And if the numbers don't match, you get a letter, a real one, in the mail. And here's a number that should calm you down even more. For the tax years 2014 through 2022, the IRS audited only 0.4% of personal income tax returns. That's according to AARP, citing the IRS's own data. 0.4%. The odds are tiny, and they get even tinier when you simply report your income accurately. So what's the most common honest mistake? According to AARP, the number one slip-up is failing to report all of your taxable income. And for retirees, that very often means forgetting a retirement account withdrawal that was reported on a 1099. Two other things AARP flags: simple math errors and using suspiciously round numbers, writing $400 instead of the real 403 or 100 instead of the real 97. Those round numbers can make a computer raise an eyebrow. Why do good people make these mistakes? Usually because they file too early, before all their 109s have arrived. Payers have until January 31st to send those forms. So what should you do? Wait until every single form is in your hands and report exact dollar amounts. That one habit prevents the vast majority of these letters. And if a letter does come, you are not helpless. Here's your protection. A mismatch notice is not automatically an audit. It's a chance to explain and clear things up. If the IRS fixes a math error and says you owe more, you have 60 days to object. If you're missing a W-2 or a 1099, you can call the IRS directly at 8008-291-040, and you can even file using a substitute form called Form 4852. And if you want help doing your taxes, AARP Foundation Tax Aid offers free volunteer tax preparation all over the country. The thing you must not do is ignore the letter, because ignoring it is what turns a small fixable issue into back taxes, interest, and penalties. So let me give you exactly what to do. 3 steps, just 3. Step 1, deposit cash honestly and all at once. If you ever have more than $10,000 in cash from selling a car, a gift, anything legal, walk into the bank and deposit the full amount in one transaction. Do not split it up. The bank filing its routine report costs you nothing and means nothing for an honest deposit. This takes one trip and it is completely free. Step 2, wait for every tax form before you file and use exact numbers. Don't file your return until you've received all your W-2s and 1099s. Remember, payers have until January 31st. Then report the exact dollar amounts down to the dollar. If you want free help, search AARP Foundation Tax Aid online to find a location near you. This protects you from the number one mistake that triggers an IRS letter. Step 3. This is the one most people skip. Open and respond to every letter the IRS sends you. If a notice arrives, do not let it sit in a drawer. Read it. If you disagree with a math correction, you have 60 days to object. If something's missing, call the IRS at 8008-291-040. If you skip this step, if you ignore that letter, a small fixable mismatch can grow into back taxes, interest, and penalties. The letter is not the enemy. Silence is. That's it. Deposit honestly and all at once. Wait for your forms and use exact numbers, and always answer your mail from the IRS. Do those 3 things and you are protected. Before you go, I'd love to hear from you. Drop a comment below and tell me, did you already know that splitting up a deposit could be a crime? Yes or no? I read every comment and I'll reply to as many as I can. And if you have a parent, a sibling, or a friend who keeps cash around or worries about the IRS, please share this video with them right now. It could save them from a mistake that's completely avoidable. That share button is right below. If you're not subscribed yet, hit that subscribe button and turn on notifications. Here at Retirement Tax and Law Pro, I break down these money and benefit rules in plain English because the misinformation out there is endless and you deserve the truth. And in my next video, I'm covering required minimum distributions, the rule that forces you to pull money out of your retirement account starting at age 73, and the steep penalty for getting it wrong. It catches millions of retirees off guard every single year. Click right here to watch it next. I'll see you there.